Welcome to the Nichols Tax Update Podcast, issue 21-33. Here's our standard disclaimer. I don't read it every week anymore, but I always acknowledge the value in preparation of this program of my subscription to Tax Notes Today. It's a valuable resource published by tax analysts, in my opinion, the preeminent source of information for tax professionals and my primary source of information for preparing this program. We have an interesting array of topics this week. One which I want to spend a little extra time on, the issue of applying for exempt status. But we have a safe harbor for employers that are using the employee retention credit, a deadline extended for claiming the work opportunity credit, updated limit on automobile depreciation deduction. Every year we get an updated limit, a few $100s difference. And then an application for exempt status denied in two circumstances, almost identical except for what they're about. One to organization formed to attract visitors to a geographic region and businesses located there. The other to an operator of an outdoor farmer's market. And then a factory bonus is not self-employment income to a car salesman. This issue rumbled around the retail automobile industry now for 2 decades. I thought this was sort of an interesting case for more reasons than one. And finally this week, a distribution to pay income tax to the members of an LLC was not a fraudulent conveyance, as that term is used in bankruptcy, and therefore not recoverable by the bankruptcy trustee. The payments were made in the ordinary course, and they were made to satisfy a contractual obligation with the members. Here we go, a safe harbor for the employers claiming the employee retention credit. This guidance allows an employer to exclude from gross receipts, and careful about our terminology here, forgiven amounts of PPP loans, shuttered venue grants, and restaurant revitalization grants. I'll get it worked out. Those are not included in gross income, we know that already, and therefore not taxable. But without this option, they will be included in gross receipts. Look at the definition of gross receipts. And the decline in gross receipts is what makes the employer eligible to use the employee retention credit. If in fact you did not have the requisite decline in gross receipts, you cannot use the employee retention credit. Never mind the effect on gross income. The safe harbor is optional. So do the math, what works out best, and if you need this option, claim it. Speaking of options, the deadline to claim the work opportunity credit on 2 classifications of targeted workers is extended. Notice 2021-43, very narrow point, but I want to use it. I want to talk about the things the IRS does with these notices. They make some very narrow points, especially right now, when we have all this confusion, all the legislation designed to make us safe from the pandemic and to rescue us from the economic difficulties. And on one provision, the tax law changed 3 times in 2 years, net operating losses, for an example. So this notice provides transition relief for employers claiming the work opportunity tax credit for 2 classifications, the designated community resident and a qualified summer youth employee, beginning work after December 31st, 2020. It extends the 28-day deadline for submitting the request for certification. It coordinates with the extension of the empowerment zone, which is where these 2 categories have to live. In order to qualify for the work opportunity tax credit, the worker must the worker who's a member of a targeted group, designated community resident, must actually live in an empowerment zone, and so must the qualified summer youth employee. The other 9 members of the targeted group do not have to live in the empowerment zone. Still, if you can get one of these workers, there's a federal subsidy in the form of tax credits. It's free help, and it's well worth the trouble and the risk. New depreciation limits on vehicle depreciation deduction. I'm not going to spend a lot of time here. If you're claiming the additional first-year depreciation, your first year is $18,200. If you don't claim the 168K bonus, it's only $10,200. After that, the annual limit is the same, regardless of what you claimed in year 1. And you get down to year 4, it's $5,860 until you have exhausted your depreciable basis in the vehicle. Here we go. A little discussion on exempt status and applying for exempt status. Two-letter rulings, both denying tax exempt status, one to an organization that's going to have a tourism promotion program, the other to an organization that's going to operate a farmer's market. Now, wait a second. Those sound like really wonderful, socially helpful, useful programs. Why can't they have exempt status? Well, maybe they could. They just can't have 501c3 status. It's too easy. And applying for exempt status is misunderstood because there's more than one application form. The Form 1023-EZ is only used to apply for exempt status as a 501c3 charity or a school. And if you're not a charity and you're not a school, you shouldn't be applying for 501c3 status. But that's what happens. People who are not well educated in this area of the tax law, who have been told they need to have you need to have a tax exempt entity to do this work, believe that it has to be a 501c3. Well, a 501c3 has some special attributes that the IRS is loath to just pass out like Halloween candy, because contributions to a 501c3 are tax deductible. And 501c3s qualify for things, for example, the tourism tax. When I used to travel and present CPE programs all over the country, I would check into a hotel and my expenses are being paid by the New York State Society of CPAs, for example. They're a tax exempt entity, and they did not have to pay the hotel tax, the additional 5% or 10% that was added to my bill if I was just a tourist to fund tourism activities. So not every exempt organization is going to be a 501c3, and so you don't use a 1023-EZ. Okay, if I don't use that, what do I use? And here's, I wanted to cover the material. So this letter ruling, who benefits? That was the question in letter ruling 2021-31013. Who benefits? The businesses selling services and merchandise to visitors. There was no government function addressed here. There was no charitable undertaking. It was all for the benefit of these merchants. And as I was preparing this slide, I said, well, they could have qualified as a C4, as a civic league, or maybe as a C6, as a business league. And then I said, well, you know what? They should file a Form 1024. But that's not exactly right. They should file a Form 1024 if they're a C6. Look at this. The 1024 is for everything other than a C3 or a C4. So here are all the things. You use the Form 1024 if you're going to apply, for example, for exempt status as a labor union, as an agricultural cooperative, as a business league. That's a Form 1024. But not the farmer's market applied for C3. They're not a charity either. The activities might qualify for exempt status under C6. But remember, no one gets a tax deduction for contributions to a C6. And it may qualify for some other benefits, but it doesn't qualify for all the breaks that you get with a C3. So maybe we're done here. No, wait, we're not. There's one more form to consider. We talked about the Form 1023 and the Form 1024. What is that other form and what does it do? Well, that's a 1024A. It's a 4-page form, line-by-line instructions in a 14-page guide issued in January of 2021. The only way you can you can file paper, but you're supposed to file electronically. Let's put it that way. No Social Security numbers. That form is going to be made public. But what is this for? It's for C4. Well, what is a C4? C4 is a social welfare organization. C4, wait a minute, what? Oh, if it's a wait. So if it's a C4, you file that special Form 1024A, but you're not done yet. You have to give the IRS notice that you intend to file the 1024A. And that's a Form 8976. It can only be filed electronically. There is no paper form. You got to figure out a way to submit $50 with that. Every new 501c4 has to use the 8976 notice of intent to operate under C4 because there was so much abuse. Well, what's the definition of social welfare? Well, let's encourage people to vote. Let's teach them how to vote. Let's teach them how to vote for Democrats. No, whoa. If you teach them how to vote, that's good. If you teach them how to vote for Democrats, you can't do that in a C4. You're going to teach them how to vote, but not specifically how to vote for this party or that party. Providing notice on a Form 8976 is no guarantee that the IRS is actually going to accept your application for exempt status. So there, the 1023, the 1024, the 1024A, and finally, the Form 8976. Next, a factory bonus paid to a dealership's car salesman for selling their cars did not make him self-employed. Before we start this discussion, I want to call your attention to the returns. They're 2014 and 2015. Remember, the law changed. The Tax Act of 2017, whatever they called it, did away with employee business expenses. So the old expenses on a Form 2106, you can't do that after 2017. But this is 2014 and 2015, and Mr. Monroe is a crackerjack car salesman. He's getting paid lots of commissions by the company he works for, but he sells so many, whatever they were, Mitsubishi automobiles, that he gets a bonus from the factory, not from his employer, but from the factory. Now, he doesn't work for Mitsubishi that makes the cars. He works for the car dealer. What does he do with this money? Well, he decides he must be self-employed. And so he keeps meticulous records of his income and his expenses and his automobile mileage. He doesn't always, however, tie that meticulous record to the business purpose. And I think he probably upset the agent because this looks like it was a very tough audit. In the end, when the judge went through all of his documentation, I thought they were a little hard on Mr. Monroe. So there was very little help from the Cohen rule, and he didn't have the attributes of self-employed that could be separated from his activities as an employee. He made a trip out of town to see a customer to sell him a car. Well, was that in his capacity as a self-employed person or as an employee? The judge, tax court judge, refused to kind of get involved in that. The car salesman is expected to incur some expenses. Mr. Monroe is not self-employed. What that meant was he was not able to claim deductions from Schedule C against his salary and wages income of about $30,000 a year. He had $20,000 or $30,000 in commissions from the factory, but he had $50,000 in expenses. The agent just blew up his whole theory of whether or not he was self-employed in his tax return. He was obviously the victim of a very difficult audit, and he represented himself not so well, I figure. But I think the lesson here is to be very careful in how we handle and how we report expenses and how we document these expenses if we're going to take a position that an employee is otherwise self-employed in a separate activity that might be related to that employee activity, but is not part and parcel of it. It's an important distinction, and it needs to be very carefully made, and you can benefit from it, I think. Distributions to pay income taxes are not fraudulent transfers. Now, we're not talking about fraud in the usual sense. Nobody was committing fraud. The LLC here complied with an agreement that it had to make distributions to its members sufficient to pay their income taxes on income that was reported to them out of the LLC. This LLC apparently was very profitable, and then it failed rather precipitously, so that it was making distributions. In a year it had big losses. It had to make distributions to help its members pay the income taxes from at least one prior year when it was very profitable. So Mr. Albert is seeking to have these payments returned to the bankruptcy estate for the benefit of the creditors. The court said, no, these distributions were for reasonably equivalent value because it's clear from the record that they were bargained for when the LLC members agreed to convert their entity from a C corporation, where they could never have any personal tax liability, to an LLC, where they would have personal liability for the taxes on any income the LLC made. So the deal was, you got to give me enough money to pay my income tax on any income that you report to me. That was the contract that they negotiated as part of the agreement to get the shareholders to sign up to convert their C corporation to an LLC. Well, gang, that's it. I thought it was a pretty interesting week, especially as I started to get into applying for tax exempt status. So let me know what you think about this development of themes. Does it help? Are we learning anything? Is there something I should know? Send the information in, post it on the SCAPA bulletin sheet, whatever they're calling that now. I look forward to hearing from you. Stay safe. We must all get through this together.